Hello, everyone. This is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, April 22nd, 2024. So we'll go over last week's results in terms of economic activity, but the takeaway is really kind of two buckets. One is retail sales, the other is real estate. And as you might guess, retail sales did really well. And the home side is definitely slumping a little bit, and we'll go through each of those. So last week on Monday, retail sales ex auto, both of those blew away the expectations, the consensus numbers. Retail sales in March were up 0.7%. Expectation was only 0.3% up. So double that. Retail sales ex auto also way up 1.1% month over month. Expectation was only 0.4%. So retail, consumer, very strong. We knew that coming in, but these are really strong numbers. Too strong because, of course, we have to worry about the market being overheated economically and not allowing the Federal Reserve to cut rates. So while they look like great data points, as you'll see for the market last week, they're actually very negative data points, despite the fact they're very positive. Secondly, on the home side, housing side, we had building permits, housing starts, both of those came in lower than expected, as did existing home sales last week. So those three data points, not a big deal, and certainly not a surprise. I think last week we did hit over 7% on the 30-year mortgage again. So not a surprise to see real estate markets slowing a little bit. So in terms of expectations now for the first quarter, which already ended, the Federal Reserve of Atlanta actually took their expectation up even further. Now they expect that the first quarter GDP number for the U.S. is positive 2.9%. Just a week ago, they expected only 2.4%. So again, that retail sales number and some other secondary numbers that came out last week definitely suggests that the economy is growing strong and therefore does not allow the Federal Reserve, or makes it much tougher for the Federal Reserve to justify taking a rate decrease at this point. So inflation expectations, the trend has definitely been up if we look at the chart since January. In January, the expectation for the 10-year inflation was under 2.2%. Now it's up. It's not dramatic, but it is somewhat significant. It's at 2.41%. Expectation for the next 10 years, still much better than what we're running at today. Then in terms of the expectations for the Federal Reserve and their ability to cut rates as investors were hoping, again, we mentioned this many times, but late last year, built into the Fed funds future market was the expectation of 6 rate cuts, or 1.5% in total. That's evaporated. So expectation now is barely the fact that we might get 1 for this year. So there's a 50% probability now, actually 53% built in to the Fed funds future market, that we will get either no change, 16% probability, or that we'll get 1 cut, 25 basis points, which is at 37% odds right now. So clearly the strong economic activity that we've seen, although it on the surface seems positive, is negative to the market because it does not give the Fed the flexibility to cut rates. So in terms of how the market reacted to that last week, negative, of course. S&P 500 down 3%, and a real reversal on a year-to-date basis is the fact that both growth and large cap trailed. In fact, last week, growth got hit particularly hard. NASDAQ last week down 5.5%. Again, the S&P was only down 3%. And value last week was pretty much flat, only down 15 basis points, and small outperformed large. Now, on a year-to-date basis, still large cap growth, still outperforming small and value, but those leads shrunk dramatically last week. International stocks also down last week, not quite as much as the S&P was, at least the developed markets. Developed markets were down 2.1%. Again, the S&P down 3.0%. Emerging markets, however, were down even worse. They were down 3.6%, although not led by China, which is normally the case. China stocks were down about 1.9% last week. In a event that has been happening quite a bit lately, of course, interest rates and expectations in yields have been going up. 2-year yield last week up 9 basis points. The 10-year up another 9 basis points. So on a year-to-date basis, both the 2 and the 10-year up 75 basis points. So last week, bonds got hit. Bloomberg U.S. Aggregate Bond Index last week down 0.6%. On a year-to-date basis, minus 3.1%. And just for fun, we'll throw in the fact that the Bloomberg U.S. Long Government Bond Index, which is 20-year duration bonds, year-to-date, although there's very little credit risk, I usually say no credit risk, but very little credit risk, down 8.4%. So good for us, Zhang Financial, in that we keep our duration on our portfolios much lower than that. So in terms of what is occurring this week, I'll just start off the first thing that we don't often talk about, but S&P earnings. So obviously, Federal Reserve, what they do directionally, whatever the Federal Reserve does, economic activity in general, GDP, the third leg of the stool really in terms of what drives the equity markets for sure is corporate earnings. So S&P earnings were right at the beginning of the earnings season, about 10% of the 500 have announced so far. This particularly happens to be a big week, particularly for the Magnificent Seven or some of the large cap growth names. So we have Microsoft this week, we have Google, we have Meta, and we have Tesla this week. It's going to be very important that they hit their numbers, beat their numbers really. Expectations are very high, pretty much across the board, maybe not so much for Tesla, but the others. And the expectation is for first quarter S&P earnings to grow 3.8%. The companies that have announced so far are below that, but it's an insignificant sample size. But 3.8% is the expectation for year-over-year EPS growth through the S&P 500. However, that's expected to accelerate throughout the year, second quarter higher, third quarter higher, fourth quarter higher. So in total, expectation is S&P earnings for 2024 will be up 20.7% versus 2023. Now, for the economic data points this week, we do have 3 housing numbers. I won't bother going through them. They're likely going to be below what they were in February. Housing is starting to slow, which ultimately will be good in terms of inflation because that has been a big pressure point. So what we will see this week that does make a difference, durable goods, we're going to see the March number. That's coming out on Wednesday. The expectation for that March number is it's going to accelerate as well. It was 1.3% month-over-month increase. During the month of February, it's expected to tick up to 2.5% in March. Then on Thursday, we do get the GDP number, first quarter number. We told you the Atlanta Federal Reserve expects 2.9%. The consensus economist index is 2.5%. And of course, in the fourth quarter, as we've talked about before, was really strong, was a positive 3.4%. Big day on Friday, maybe even bigger than Thursday, inflation. This is the big driver. Inflation, personal income, personal spending, consumer confidence all hit on Friday. So core PCE and PCE on a month-over-month basis for March, both of those indices are expected to be up 0.3% month-over-month, which is what they were in February. So no change, but still that's a run rate of 3.5, 3.6% on an annual basis. And we know the Federal Reserve has targeted 2.0. At some point, we would guess the Federal Reserve will come off that very high standard of getting it down to 2.0, but 3.5 is definitely not high enough for the Federal Reserve to justify rate cuts at this point, particularly if GDP is going to come in at 2.5 to 3% for the first quarter. Now, one good metric coming out on Friday we expect will be personal income. The expectation is that'll be up 0.5%, very important, in that if that does come in at that point and inflation is PCE 0.3%, then we have actual real income growth for the consumer, which would be a positive. So we're barely or getting close to the point we were from a purchasing power standpoint back in 2019. So personal spending is also coming out on Friday. That's actually expected to be down a little bit, which would be, again, good for inflation. Month of February was up 0.8%. For the month of March, it's expected to be up 0.6% month over month. Last indicator on Friday, Michigan's consumer sentiment. I think it's the final number. The expectation is for April that will come in at 77.8%, down slightly from the month before at 79.4%. So that's it for the recap, and look forward for this week. Thank you very much for attending. We'll look forward to seeing you next week. Thank you.